Hello, Spartans. My name is Caleb Lewis. I am chair of the School of Business. I'm glad you're watching today. I have a few tips to share with you about building a good credit score. So first, I'd like to really emphasize that your credit score is just a number that relies on information in your credit report, which is a summarized accounting of everything that's in your credit history. So let's try to keep those ideas distinct as we go forward here. So first of all, talking about those credit reports, your credit report is maintained by a credit bureau. In fact, there are 3 credit bureaus in the United States. They maintain a lengthy record about your spending and borrowing habits. It also includes information about past addresses and information about potential court liens against your property and child support and all kinds of things. It can actually be a quite comprehensive document. This credit report has a summary of your credit history. It is that information that is used to determine your credit score. So the credit score itself is just a number. It is a number used to summarize all of that information. And like any summary, it loses a lot of the important detail there. So it's a really good idea for you to keep an eye on that credit history and the payments and other factors in your credit history to make sure you know what's going into your credit score. The most commonly cited credit score by far is the FICO score. This FICO score has a range from 300 to 850, with generally being a higher credit score, meaning you are a lower credit risk and therefore you'll get better terms. The highest credit score category is excellent. You will get lower interest rates, lower fees, better terms on other lines of credit and credit cards that you might have. So while we don't know exactly what goes into the algorithm that determines the FICO score, we do know the ingredients in that recipe. The number one ingredient by a fair margin is your payment history. That is the length of outstanding credit payments that you've made over time. The next entry on that is the amount of credit you have available to you. A key aspect of that is of the credit you have available to you, how much are you using at any time? We'll talk more about that. The length of that history is an important factor as well. So it is not just, as I mentioned, the on-time payments, that component there is important. The length of that credit matters also. It is also an important part of the mix here is your new credit. And if you are out seeking a home loan and a personal loan and a credit card, this is probably a sign that you're in a position where you're borrowing too much, and it may be a signal about your credit worthiness. So the amount of new credit you're seeking is an important factor as well. And then, interestingly, the mix of credit that you have. If you have only student loans or only credit cards, that can be a sign of interpreted as a sign of your credit worthiness as well. So it's generally a good idea for a person to have a variety of forms of credit. The problem can be starting with a limited credit history. How do you get going? Well, generally, it's a good idea to apply for and get one form of credit. Most often, that's a credit card, and open up that line of credit. Use that line of credit to buy things you were already going to buy. When you receive your monthly statement, pay off that balance every month so that you aren't carrying debt month to month. You keep that process going. You keep that account active. Again, you're only spending that money that you were already going to spend, but you're spending it through the mechanism of your credit card instead of maybe through your debit card or using cash. In this way, by not expanding your quality of life and spending outside of your means, you are instead keeping track of all of the spending you were already doing and effectively getting credit for it, pun intended, by building this lengthy credit history. Another important possible strategy is to become an authorized user. An authorized user is someone who is permitted to use another person's credit card. That other person's credit history now gets added to your credit history. Now, the interesting thing about this is that when you're an authorized user, you do not need to use or possess the card. So you might be able to have your parents or someone you trust who you know has a good credit history add you to their credit card as an authorized user. You never need to use it, you never need to spend it, you never need to possess the card, but so long as you are an authorized user, their credit history counts on your credit history as well. You could use this then to get access to a better credit card or other credit terms. Take some time while you're still an authorized user to build out your own credit history, and then be removed from the card as an authorized user. And now you've got your own established credit history and a solid credit card or credit line with good terms. A similar strategy is through the use of loans. There are loans out there, such as credit builder loans, where you actually prepay the loan. So you would go to a bank and you would say, I want to establish a credit builder loan. You would make payments, let's say up to $100. After you've made your loan payments, only then does the funds from the loan actually become available to you. Through this way, you can demonstrate a history of payments on a loan, and the bank is not exposed to any risk. And so they're willing to offer you this credit building loan because it benefits you, but it also benefits them as well. A similar strategy involves a loan, but in this case, you put something of value up behind that loan. The most obvious example being a car loan or a mortgage, in which the asset, the car, or the home is the collateral that backs up that loan. For a person with limited or poor credit history, that collateral is what stands in to protect the bank, or the lender at least, from risk. So a secured loan is one way in which you can get access to credit when your credit score or credit history might hold you back. Similarly, you might be able to find someone who is willing to co-sign, who is willing to put their name on a loan in your name. Now, a key piece here is that that person is assuming liability. If you don't make the payments on that loan, they are held liable. So it definitely takes a trusting relationship, but a person who's willing to co-sign on your loan is effectively vouching for you and using their credit history to help you get better terms on your loan. And in that way, they can help you get started building this record of making payments on a loan. Another important piece to keep here in mind is that not everything that you're paying right now is on your credit history. In fact, a number of things like rents to small-time landlords, your cell phone bill, and your utility bills, these may not be being recorded in your credit history. So you may have a lengthy history of responsible payments and managing your finances well, but none of that is showing up in your credit history. Now, again, one way of accomplishing this same effect would be to pay those things with your credit card and then pay your credit card off on time. However, a number of services these days are available to allow you to get effectively credit for the payments you're already making. I've listed a couple here: Rental Karma and RentTrack are third-party companies who will track this information for you. But Experian, one of the credit bureaus that we mentioned earlier, has a service as well where you can have your utility bills and your cell phone bills reflected in your credit report. Now, that's only reflected in your Experian credit report, but it is one of the three, and many lenders are likely to pull that credit report and see that history on there. And so the Experian Boost tool is one way of getting entries that are not on your credit history reflected there. Now, a key thing is, once you've established a good credit history, a good credit score, is keeping that good credit score. One of the things you'll want to do here is you'll want to keep your credit balances low. What we want to do is use 30% or less of the credit limit you have access to. That's one of the features tied to that kind of special sauce from the FICO score that is pretty important. The amount of credit you have access to, but also what share of it you're using. And you only want to be using up to 30% of the credit you have available to you. You also, again, don't want to be seen as applying for multiple lines of credit simultaneously. That's generally considered a signal about creditworthiness. So if you're in a position where you need access to credit, you don't want to be out there submitting lots of credit applications at the same time and seeing this kind of significant impact on your credit score, this expansion of your credit lines and then your utilization. So it's a good idea to keep a small number of credit cards, or even just one, and use that and not be seen as regularly applying for and expanding the amount of credit you have and in utilizing all of that credit. And as we noted before, an interesting feature of the FICO algorithm is the mix of credit that you have. So it might be possible for you, for example, to use your credit card to pay for your car or something like that. But it's probably to your benefit instead to have a car loan for one purpose, student loans for something else, and a credit card that you use for other kinds of purchases. That mix of credit is also a good sign in terms of your credit worthiness. So these are just a few of the strategies that you might use to develop, build, and maintain a good credit history. I hope that you found this informative. A number of resources will be provided should you choose to look into this information more in the future. Thank you.